You found the answer. You are certain of it. Dividends. Passive income. Money landing in your account every single quarter without you lifting a finger. That is the dream. And right now, millions of people are building their entire financial futures around it. They are buying high-yield stocks, calculating exactly how much income they will receive each month, mapping out the precise date when the checks will cover the rent. But here is what almost nobody tells you. The strategy that promises to set you free might be the very thing keeping you trapped. Let me reframe everything you think you know. Most people discover dividend investing the same way. They are exhausted. Exhausted from trading time for money, from watching their paycheck dissolve before the month is over, from feeling like no matter how hard they work, the numbers never move fast enough. And then someone, a video, a forum post, a coworker with a brokerage account, mentions dividend stocks. You invest. The company pays you. You do nothing. It sounds almost illegal in its simplicity. That feeling? That is exactly where the trap begins. Here is what is actually happening every time a company pays you a dividend. The company reaches into its own cash reserves and transfers that money directly to you. That sounds like generosity, but the instant that cash leaves the company is worth precisely that much less. The stock price adjusts automatically on what is called the ex-dividend date, which every major exchange in the world processes without exception. You receive $1 per share. The stock drops by approximately $1 per share. You are not receiving free money. You are receiving a slice of what you already owned, handed back to you in a different form. This is not a conspiracy theory. It is not a loophole. It is foundational accounting, documented in financial literature going back more than 60 years. In 1961, economists Franco Modigliani and Merton Miller published what became one of the most replicated and cited papers in financial history. Their argument was radical at the time. In a perfectly efficient market, they wrote, dividend policy is completely irrelevant to total shareholder return. Whether a company pays dividends or reinvests that same cash back into its own growth, the total wealth created for the investor is mathematically identical. Modigliani and Miller both went on to win the Nobel Prize in economics. Their core finding, that dividends do not manufacture value from nothing, has never been seriously overturned in the decades since. So why does the dividend trap feel so real? Because your brain was not built for modern markets. It was built for a world where receiving something felt fundamentally different from not losing something. Psychologist Daniel Kahneman spent decades studying this exact asymmetry. In his foundational research on mental accounting and loss aversion, Kahneman found that humans assign different psychological weight to money depending on how it arrives. A dividend payment that lands in your account registers as a gain. It feels like proof that the machine is running. A stock that grows quietly in value without ever writing you a check feels abstract, theoretical, almost imaginary. Your psychology insists the dividend belongs to you in a way the unrealized gain does not. It does not matter that they are worth exactly the same amount. Your brain does not experience them the same way. And that gap between what feels true and what actually is true is where most investors lose the game without ever realizing a game is being played. This is why millions of people will accept a lower total return in exchange for quarterly payments. They feel wealthier, they feel productive, they feel like the market is rewarding them personally. And all the while, the investor in the next account, holding a low-cost total market index fund that pays a modest or zero dividend, is quietly compounding more wealth with fewer tax events and no psychological illusions about where the return is actually coming from. That word, taxes, matters far more than most dividend investors want to acknowledge. Every dividend payment is a taxable event the moment it hits your account. In most countries, qualified dividends carry their own rate, and unqualified dividends are taxed as ordinary income. You owe that money regardless of whether you needed the cash, regardless of whether you had any intention of selling those shares at that moment, regardless of your 5-year plan. The growth investor who holds appreciating shares controls exactly when to trigger a tax liability. They can wait. They can plan around a low-income year. They have a choice. The dividend investor receives no such choice. Over 30 years inside a taxable brokerage account, the difference in tax drag, small each year but compounding relentlessly, grows into a number large enough to shift your retirement date. Not by months, by voltiers. Now here is where the story turns. a study published by Vanguard's Investment Strategy Group and later built upon by financial author William Bernstein in The 4 Pillars of Investing, tracked the long-run performance of high-dividend strategies against broader market benchmarks across multiple market cycles. The findings were consistent. High-dividend portfolios did not reliably outperform the total market on a total return basis. What they did reliably produce was the psychological experience of income. And that experience carries real value, not because dividends create extra wealth, but because they keep investors calm during crashes. The dividend investor who receives a quarterly payment while the market falls 30% is far less likely to panic sell, because the cash keeps arriving regardless of the price on the screen. The excess return does not come from the dividend itself. It comes from staying invested while others run. The dividend is not the engine. It is the sedative that stops you from sabotaging the engine. Think carefully about what early retirement actually requires. You need a portfolio large enough that a sustainable withdrawal rate, historically modeled at somewhere between 3.5 and 4% annually, covers your living expenses indefinitely without depleting the principal. That is the entire equation. Whether that 4% comes from dividends, from selling a small percentage of shares each year, or from some combination of both is completely irrelevant to the math. What determines when you retire is the total size of the portfolio. Only that. And this is exactly where a rigid dividend focus costs people years of their lives. By restricting their holdings to dividend-paying companies, investors voluntarily exclude entire sectors of the market. The highest growth and highest innovation companies of the past 3 decades, the ones responsible for some of the most extraordinary wealth creation in modern financial history, paid no dividend whatsoever. They reinvested every available dollar back into their own expansion. The investor who demanded a quarterly check watched these companies from the sidelines. The investor who did not make that demand held them for 20 years and never had to think about retirement at all. Researcher John Cochran at the University of Chicago spent years studying the long-run predictors of equity returns. One of his recurring findings, dividend yield is a weak predictor of future price performance when compared to earnings growth and valuation metrics. The systematic hunt for yield, the obsession with the income number, consistently steers investors toward mature, slow-growing businesses in sectors that have already seen their best decades. The dividend arrives reliably on schedule. The share price, over time, often does not keep up with the market it belongs to. So what does the person who actually retires early do differently? They optimize the total pile, not the quarterly payment. They do not care whether their return arrives as dividend or as price appreciation, because they understand these are simply 2 forms of the same thing. They hold broadly diversified low-cost funds. They minimize fees. They minimize tax drag. They invest as aggressively as their time horizon and temperament allow. And when the time comes to draw down, they sell a small number of shares each year. A strategy that financial planner Michael Kitches has documented across multiple analyses to be more tax efficient in most scenarios than an equivalent dividend income stream. They never confuse the sensation of being paid with the math of building wealth. This is not an argument against dividends. Many dividend-paying companies are fundamentally sound, well-managed businesses, and reinvesting dividends automatically inside a diversified index fund over several decades remains one of the most powerful wealth-building strategies ever documented. The belief that money arriving without effort means you have already crossed some invisible finish line. That story is a sedative dressed as a strategy. Because while you are watching the income number, the deeper questions go unasked. Is your total portfolio growing fast enough? Are your fees low enough to matter over 30 years? The dividend becomes the number you watch instead of the strategy you interrogate. You started reading this because you believe dividends were the answer. Maybe they still are. As part of a low-cost, diversified, tax-aware portfolio, where income is one feature among many and not the entire point. But now you know what most investors only understand after years of watching their balance lag the benchmark. The trap was never the dividend itself. The trap was mistaking the feeling of being paid for the mathematics of becoming free. And the moment you can tell those 2 things apart, you stop chasing the check. And you start building the life it was always supposed to represent.